Santanu Sengupta is joining us now. He's the India economist at Goldman Sachs to talk more about macro. Shantanu, afternoon. Thanks so much for your time. We all are observing the way markets are cheering and not only scaling the previous highs but building on. And the contribution coming in from favorable macros for India. That is something I would like to discuss with you. Monsoon, for example, lower crude, the other. Before I come to your observations and your note on growth, etc., how much weightage would you give to these factors?
Yeah, sure. Thanks for the question. So the monsoon progress over the last week in particular has been good. So about a week back, you had 33% deficient monsoon to the long-term average. The numbers as of yesterday will be about 13%. So that's a clear improvement. I think the more important thing is that most of the sowing in India takes place in the month of July. So as you head into July, it was important for the monsoons to pick up, and rains clearly have picked up, and therefore that augurs well for overall growth. Now, in terms of contribution of agriculture, it still remains around 15%. So while that section of the economy benefits from monsoons, for the overall economy, ultimately services growth, investment growth, manufacturing growth is important. So that's how we would be looking at the overall growth picture.
I was looking at your growth estimate for India at 6.4%. There is also some view that perhaps we could be expecting this very aggressively because the world is actually slowing down, and the deceleration engineered by central banks may not get arrested in a hurry. Your growth estimate, what are your prognosis on various elements which will be contributing to that kind of India growth?
Sure. So the 6.4% is a calendar year 23 growth forecast by us. The fiscal year 24 is 6.2% compared to the RBI's 6.5% growth forecast for the fiscal year. It comes also, the calendar year forecast comes also on the back of a stronger than expected Q4 FY23 or Q1 CY23 number at 6.1% year over year, where we saw the strongest sequential investment growth non-seasonally adjusted since 2000 and robust government spending. For the overall year, the main contribution to growth comes from the net export boost, because the current account deficit, in our opinion, moves from roughly the 3% of GDP handle to about 1.5% of GDP handle. So that is creating a net export boost for the overall calendar year, which is why we are optimistic on growth. I think the more important view, in our opinion, is on the growth overall cycle, which is this is a cycle of very low macro vulnerability for India. So if you think about the FII lens of looking at India, it's always been that there'll be an inflation blowout and therefore rates will have to blow out, or there'll be a current account blowout and therefore currency will have to blow out. In this cycle, we think that inflation has been very well arrested. We are already past the peak in terms of headline inflation. We'll have to see core inflation still come down by the end of the year. And again, importantly, because of the support that you're getting from services, exports, and remittances, the current account is very well contained. So the currency has been largely stable when you consider what's going on around the world in a Fed cycle where the Fed funds rate is already at 5% plus. So that creates very conducive conditions for growth in India with this period of low macro vulnerability.
When you say that perhaps the inflation could be past its peak, how do you see our own central bank stance? We did not hike in the same proportion as perhaps the US Fed, and we can assume that we may not cut in the same proportion, and in fact we may not hurry to cut in. But what's your stance on how we will take the trajectory from here after a long pause? How many cuts? When does the first cut come? All of that.
Sure. So in terms of inflation, firstly, we are averaging out around 4.5% for the current quarter, and then we go higher. So this is also the trough in terms of inflation, in terms of at least 1 year forward. But you don't go back, in our view, beyond the 6%, which is the upper end of the RBI's target band. In our view, you remain around the 5.5% and then slowly move down towards a 5.25 kind of range by the end of the year. Importantly, core inflation, in our opinion, is driven by two factors. One is core goods inflation, which is already running. It was running at about 7.5%, which we think will come, largely down towards about 4% by the end of the year. But core services, given where the growth cycle is likely to remain sticky, in our opinion. So given this core inflation going down only towards about 5% in our forecasts, and the Fed hiking cycle continuing into July, which is what the market is also pricing in now, we don't think that the RBI can cut at least by the end of the calendar year. So we have a long pause till the end of the calendar year. If things are conducive early into next year, then in Q1 of next year is when you can start seeing the RBI easing. Having said that, this cycle is likely to be shallow because you've already stopped at 6.5, which you alluded to in terms of the repo, and hence the cutting cycle this time is also likely to be shallow.
That's a very interesting point. Just I think a week back, IMF made a comment, and Geeta Gopinath from there said that she was of course referring to the global environment, saying that the global markets actually assuming too much in terms of they are assuming it too soon that the rate cut cycle would start. Yesterday there was a global central bank meet in Portugal where some commentary from US Fed actually came in. What are your thoughts over there, the global cycle? Because data over there is very patchy. There are some central banks which are talking of stimulus as well. US is saying no hurry, 2 more hikes probably on the table. How are you looking at those things?
Right. So our US economists have been above consensus in terms of their growth forecast pretty much since the beginning of the year. We are forecasting 1.8% real GDP growth in US for 2023 versus 1.3% real GDP growth consensus. And remember, the consensus growth has been upgraded over the past quarter or so. So growth data has been resilient globally. We have one more Fed rate hike in our forecast for the next meeting. And then we have a long pause until Q2 of next year. While the Chinese growth, in our view, is around consensus of 5.5%, we are at 5.4% year over year for 2023 China growth. So our view remains that the Fed goes one more time. It remains on a long pause till Q2 of next year. If the Fed rate cut goes through in Q2 of next year, just before that in Q1 is when we are pricing in the first rate cut from the RBI.
One last question. In fact, you've also made a very important observation, and that is that we shouldn't forget that we are in an election year. This government or the policy makers have been pretty on the pretty forward out there as far as a lot of measures related to kickstart manufacturing and capex is concerned. But you expect this year in particular to be very high on capital expenditure, and state capital expenditures also usually become very active. How important would that factor be in growth?
We are taking in the budget estimate from the central government, which was quite different from what you see in other pre-election years. Typically in pre-election years, you see a move from the government towards more transfer payments or rural expenditure. The government this time around has made a very strong statement in terms of allocating 3.3% of GDP on capital expenditure. That's a 60 basis points, 70 basis points almost improvement over what you saw in the previous fiscal year. So they're very committed to the capex cycle. Most of the capex in terms of infra spending until now is being driven also by the government. So clearly that's an important lever in terms of investment growth for India. For the private capex cycle, though, we think that the supply side conditions are looking very conducive. One, manufacturing companies have deleveraged. In fact, their leverage is probably, the balance sheets are probably one of the best in the last 20 years. And also, most of the large private sector banks and the largest state-owned lender is also in very good shape in terms of their capital ratios. that creates a conducive environment for the private capex cycles to start, but probably that's more for next year than this year. As you head into the election cycle, into the second half of the year, you will probably see government expenditure picking up as the elections get closer.
Shantanu, when this kind of a capex cycle from the private sector also does gather steam by next year, which your hypothesis is, usually how prolonged does it get? Can you give us any idea, looking at previous cycles, does it last? What does the setup look for this time around?
I think what the government is trying to do is a couple of things. One, having strong balance sheets of both the corporate sector as well as the banking sector. So if you think about the last cycle, until the second half of the last decade also, India was impaired by balance sheet problems with both banks and NBFCs, as well as the corporate sector, whereas the government balance sheet was getting cleaner because we were on the path of fiscal consolidation. Come COVID, most of the debt has been now taken on the government's books. Even the quasi-government sector has been cleaned up. If you think about how FCI debt was transferred onto the on-balance sheet for the government, and banks went about raising capital during the same time. So the private part of the economy, which is, again, the corporate sector and the banking sector, is cleaner. The government has got more indebted, and that should make it more sustainable this time. Along with that, the government is doing newer things which have not been seen in earlier cycles, like an export incentive, which is based on production, essentially, which is the PLI. It's still very early days. It takes much more to become a manufacturing powerhouse globally. But India is taking the right strides in terms of making the companies competitive at an international scale with incentives on the PLI, etc.
Absolutely, and it is witnessing very good reactions from the industry as well. Shantanu, thank you very much for your time and your contribution. Pretty exhaustive view coming in from the Indian economy from Shantanu.